Imagine staring at a screen as a stock you're heavily invested in suddenly just plummets. I mean, the red candles are flashing, your heart rate spikes, and your brain is basically screaming at you to hit the sell button just to stop the psychological pain.
Oh, absolutely. It's pure panic.
Right. But then there's this tiny, unemotional line on your chart, the
Yeah.
2-minute 8 EMA, and it hasn't actually been broken yet.
Yeah,
So do you trust your gut, which is, swimming in adrenaline, or do you trust the math?
that is the ultimate question, isn't it?
It really is. And welcome to today's deep dive. We are taking an exclusive look into a master class on trading today. Specifically, we're drawing from Mastering the Trade, Strategic Rules for Market Execution.
Yeah, and it's a fascinating source text.
It is. Our mission for you today is to really decode the mindset and the tactical rules used by high-level traders to execute under pressure. We're looking past those Hollywood stereotypes of screaming brokers and gut-feeling bets.
Right, because surviving in any high-stakes environment, it requires a framework that completely overrides our natural instincts.
Because even if you aren't a day trader, this is just a profound study in emotional control, right? It's about decision-making.
Exactly. The market is just highly efficient at punishing human nature. I mean, it preys on loss aversion, the fear of missing out. Our egos need to be right. So the goal here isn't just learning what to trade, but why strict rules prevent us from becoming our own worst enemies.
Okay, let's unpack this because the text challenges our foundational assumptions about risk right out of the gate. There's this pervasive myth that to make big money, you need massive capital and you have to deploy it all at once.
The classic go big or go home mentality.
Yes, but the instructor explicitly says, and this is the quote of the day, you don't need big share size to make big money in the markets. You just need to be right and know how to hold trades.
Which is such a counterintuitive lesson.
It really is. I mean, I find that hard to reconcile. If the goal is maximizing profit, taking a smaller position just seems mathematically counterproductive.
Well, it seems counterproductive until you factor in the psychological paralysis of a drawdown. If you deploy your entire account on a single entry and the stock immediately ticks against you, your fight or flight response triggers instantly.
Oh, for sure. You just want out.
Exactly. You are way more likely to panic sell at a slight loss just to relieve that stress. So the instructor advocates for taking a starter or a feeler position. You size into the trade in tiers.
I really like that. It's like dipping a toe in the water before doing a cannonball, right? You test the temperature of the market before committing your full weight.
That's a perfect analogy. What's fascinating here is how they illustrate this with a trade on Micron.
Right, the Micron example.
Yeah, so the trader initiated a really small feeler position right at the open. They didn't assume the breakout was genuine. They waited to see if the price would retest a specific level and actually hold it.
Before going all in.
Right, before adding their full tier. Because a stock breaking a level could just be a temporary imbalance of orders, but when it pulls back and holds...
Meaning it becomes support.
Yes, exactly. That shows institutional buyers are actively defending that price. It shifts the entry from, blind hope to calculated evidence.
And this is where it gets tricky.
Yeah.
The text immediately presents a glaring exception to this rule.
Yeah.
The instructor highlights a trade on the ticker CNSP, where they just abandoned the feeler strategy entirely.
Yeah, they really did.
They set up a massive buy stop at the break of the pre-market highs, and they used a specific 15-cent offset. If the golden rule is to protect yourself by scaling in, why suddenly throw the full weight of the account at a pre-market breakout?
Well, because the underlying mechanic of that catalyst demanded a totally different execution. CNSP wasn't just a standard technical setup.
It had news.
Massive news. It had a 270% oversubscribed private placement.
Wow.
Yeah, an oversubscribed offering of that magnitude means there's ravenous institutional demand, far more buyers than available shares. So in that specific context, the trader recognized that if the stock broke that pre-market high, it wasn't going to politely pull back for a retest.
It was just going to explode.
Exactly. The buying pressure was going to cause a massive gap upward.
Which totally explains the 15-cent offset on the buy stop.
Yeah.
I mean, if they just used a standard market order on a breakout like that, slippage would absolutely destroy their entry point.
Their order would get filled way, way above where they intended.
Right, and if they use a strict limit order.
Then the price might just gap right over their bid, leaving them completely behind. So that 15-cent offset acts as a structural net.
Like saying to the broker, buy it right when it breaks, but don't pay more than 15 cents over.
Precisely. It's aggressive, but it's a highly calculated execution based on supply and demand, not a random gamble.
Okay, so once that entry is executed and the position is actively making money, the dynamic completely shifts.
It does. We move from entry to exit.
Right. The text pivots heavily into exit strategies, and they introduce the concept of the average true range, or ATR. Let's break down those mechanics.
Sure. So the average true range calculates the historical volatility of a stock over a specific period. It shows exactly how much it typically moves from its intraday high to its intraday low.
So if a stock consistently moves $5 a day, its daily ATR is $5.
Yes. And the instructor treats this metric as an absolute physical boundary. If a stock has already passed its daily ATR, the risk reward for a new entry is entirely gone. Don't chase it.
It's like looking at a car's fuel tank. If the ATR is $5, that's its max fuel capacity for the session. If it's already moved $4.50, you're buying a car running on fumes.
That's spot on. The engine is going to stall no matter how good the chart looks. And the Micron trade from earlier is the perfect case study for this.
Oh, right, from the Q&A session.
Yeah. A student noticed Micron was still climbing and asked if they should initiate a new long position, and the instructor gave a definitive no.
They were pretty blunt about it.
Very blunt. They said if it's past its ATR, you're doing it backwards. You missed that trade. Capturing 70 to 80% of an ATR is actually a massive win. They closed their Micron position for roughly 25 points on a 29-point ATR. Chasing those final 4 points, it's just mathematically unjustifiable.
Okay, I hear that, and it makes logical sense. But it kind of ignores the reality of human behavior, doesn't it?
How do you mean?
Well, this sounds perfectly logical on paper, but if I'm watching a stock hit its target, human nature is screaming at me to either take all the money and run right then, or get totally greedy and hold everything. Taking only a partial profit, what they call trimming, feels inherently wrong.
This raises an important question about how we process wins and losses.
Because isn't trimming at the first target essentially cutting your winners short?
It feels like it, yes. But holding a full position indefinitely exposes you to loss aversion. Once you own a stock, your brain artificially inflates its value based on the unrealized gains flashing on your screen.
Oh, I've been there. You start mentally spending the money.
Exactly. And if the stock suddenly drops, the pain of losing those unrealized gains is psychologically devastating. So the trim and trail method perfectly hacks human psychology.
By booking partials.
Right. By selling half or a third of your position at the first logical target, you secure actual cash. You satisfy your brain's desperate need for a win.
You're paying yourself for being right.
Yes. And once you secure that capital, your emotional baseline resets. You are now playing with the market's money. This allows you to tolerate the intraday volatility of the remaining position, the runners.
And to manage those runners, the instructor relies on that mechanical trailing stop we mentioned earlier, the 2-minute 8 EMA.
The 8-period exponential moving average on a 2-minute chart. The math there weights recent price action much more heavily than older data, which makes it hug the current price very tightly.
Which is vital for day trading, right? Since things shift in seconds.
Absolutely. It acts as an emotionless bodyguard. As the stock climbs, the 8 EMA climbs right behind it, and the rule is absolute. A close under that line means you are out.
Just mechanically out.
Right. During the Q&A, they clarified that while you usually measure from the close of the 2-minute candle, intraday you can also measure from the open. But the function is the same. It completely removes the burden of decision-making.
So you aren't sitting there agonizing over whether it's a temporary dip or a massive reversal. You just watch the line.
Exactly. The text demonstrates this with a trade on CRWV. The instructor was holding a runner and explicitly told the students, if a trade has given you no reason to sell, don't touch it. The 8 EMA mathematically dictates when that reason has arrived. Let winners run, cut losers short.
Here's where it gets really interesting, though. You can have the perfect entry and a perfectly disciplined exit. But if the overall environment is toxic, none of it matters. We really need to zoom out from individual trades to the macro market context.
Tape reading and risk. Because the vulnerability of any moving average strategy is the macro environment. When volatility spikes, moving averages fail completely.
That is produce endless whipsaws, right?
Endless. Constantly triggering your stops as the price violently chops back and forth. If we connect this to the bigger picture, survival isn't just about managing your specific trade. It's about recognizing when the structural integrity of the entire market is compromised.
Like reading the weather before sailing. You can be an expert sailor and know exactly how to trim your sails. But if you ignore the dropping barometer and the dark clouds rolling in, your boat is going to sink.
That is exactly it. And the text points out a huge warning sign early in a trading session, a structural divergence between major indexes.
Right, the Qs versus the spiders.
Yeah. The Qs, which track the Nasdaq, look like they were setting up for continuation. But the spiders, tracking the S&P 500, looked distributive.
And that's a massive red flag.
Huge, because the Nasdaq is heavily weighted toward massive tech companies. If the Qs are pushing higher, it might just mean 3 or 4 mega-cap stocks are catching bids. But if the spiders are distributive, meaning institutional sellers are actively offloading shares, the underlying foundation is rotting.
You just can't trust a rally built on a handful of stocks while the other 490 are facing liquidation. The spiders will eventually drag the whole market down.
Exactly, which is why patience is so critical. After the opening drive, the instructor adheres to a strict rule. Wait until 10:30 a.m. to see what the initial balance looks like before taking new positions.
Let the aggressive algorithmic rebalancing burn off.
Right. See who actually has sustained control,
Right.
the buyers or the sellers.
And the consequences of ignoring this are heavily emphasized in the afternoon recap section. The instructor issues a severe warning. They describe the afternoon environment as highly inhospitable.
Yeah, that was a great word for it. Inhospitable.
The volatility index, the VIX, was elevated at 18.2, plus down volume heavily dominated up volume by a massive margin, 615 to 385.
And the mechanics of an elevated VIX change the entire risk profile. A VIX over 18 means options pricing is factoring in violent, unpredictable swings.
Combine that with the skewed down volume.
And the environment is inherently toxic for long positions. Almost 2 shares were being aggressively sold down for everyone moving up. The rule here is simple: do not overtrade. Step back. You don't try to be a hero in a toxic tape.
Okay, assuming the market weather is actually clear, the VIX is calm, the indexes are aligned, how does a master trader choose which specific wave to ride?
Well, the text reveals a ruthless filtration system for finding high conviction setups, and it starts with the daily chart.
And the foundational rule there is blunt. If the daily chart looks like crap, don't trade it. It doesn't matter how good the intraday move looks.
Not at all. The daily chart represents the overarching institutional narrative. If a daily chart is in a prolonged downtrend, every single rally is going to be met by trapped investors desperate to sell and break even.
It's an invisible ceiling.
Exactly. When you trade a pristine daily chart, you align your intraday entry with the dominant institutional momentum.
And the source outlines several specific architectures that meet this standard, like IGV, which had a powerful 4-month base breakout.
A 4-month base is extreme market equilibrium. Buyers and sellers are deadlocked for 120 days. When it finally breaks out, it shatters that equilibrium, traps the short sellers, and creates a massive vacuum of buying pressure.
Wow. They also mentioned Google, which had a beautiful inside bar breakout off the ORB, the opening range breakout.
Another fantastic high probability setup.
And Amazon. The text described Amazon as having a flat top base with a two-way corrective inside it, which sounds incredibly technical.
It does, but the architecture is fascinating. A flat top base indicates a massive passive seller is sitting at a specific resistance level, absorbing every buy order. The price just hits the ceiling and stops dead.
But the two-way corrective part means the buyers keep stepping back in at higher and higher prices, right?
Exactly. Higher lows. The tension continuously builds until the massive seller finally runs out of inventory. Once that flat top breaks, there is zero overhead supply left.
It's free to run. They also noted Palantir needing to clear overhead supply and NVIDIA requiring a break of the 200 level with heavy volume to validate a descending triangle reversal.
Which the instructor confirmed actually triggered later, moving up $1.55.
Right. But amidst all this rigorous mathematical precision, there's this profound moment of human error in the text, the NBIS trade.
Ah, yes. The NBIS trade.
We've spent this entire time analyzing emotionless execution, strict parameters, algorithmic discipline. Yet the instructor openly admitted to their students that they completely missed the 2-minute ORB entry on NBIS, and out of frustration, they actually chased the trade.
They did.
And the daily chart on NBIS wasn't even pristine. They noted it was not the prettiest, even though it had a valid 15-minute pop and flag setup. So my question is, why leave an admission of failure in a masterclass designed to teach flawless execution? How important is that?
It is arguably the most important lesson in the text, because flawless execution is a dangerous illusion. Presenting a facade of perfection creates an incredibly fragile trader.
Because the moment they make a mistake,
Their rigid framework shatters. They spiral into catastrophic risk-taking. By admitting the error live, the instructor shifts the paradigm from perfection to risk management. It's the ultimate display of market maturity.
They acknowledge the mistake, but they don't let it dictate the next decision.
Exactly. The protocol isn't never make a mistake. It's instantly identifying the cognitive failure-like feeling FOMO and chasing and entry managing the altered risk profile and refusing to compound at the error. You survive by ruthlessly containing the blast radius of your mistakes.
Which brings all these seemingly disparate rules into sharp focus. Take starter positions, respect the ATR, use mechanical trailing stops like the 8 EMA, refuse to trade terrible daily charts, and step away when the broader market tells you a storm is brewing.
It's a cohesive system of psychological defense.
It really is.
Yeah.
So what does this all mean for you, our listener? Even if you never buy a single share of stock, the mechanics of trading are ultimately just the mechanics of resource management under duress.
That's a great way to put it.
And the resources we protect don't just have to be financial capital. They can be our time, our energy, our emotional bandwidth. Think about how often we ignore our own average true range.
Just all the time.
When you're deeply entangled in an argument or grinding through a brutal project at work, there comes a point where you are completely depleted. Your emotional APR has been maxed out.
You're running on fumes.
Exactly. Yet cognitive bias and ego often convince us to keep pushing, to force a resolution, to chase a broken setup. But the market teaches us that when the environment becomes toxic, when your emotional VIX spikes, the most strategic move is to step back.
Don't try to be a hero on a toxic tape.
Exactly. Maybe it's time we all learn to set an emotional trailing stop, to recognize when the risk-reward is gone, lock in what stability we have left, and simply walk away until conditions improve.
That is a powerful takeaway.
Thanks for exploring the architecture of execution with us today. We'll see you on the next deep dive.